What is the full retirement age for Social Security? I'm going to go into that video right now and whether you should be waiting for that full retirement or not. What is that full retirement age for Social Security? Now, if you just Google it, you're going to see 67. That's it, right? You're done. But imagine if you're on here right now and you're looking this up and you want to get a little bit more detail. Maybe you're wondering, should I actually wait till my full age of 67 or should I take out Social Security sooner, especially if it's going bankrupt in the next possibly really less than 10 years. There's prediction that it could be losing money. You could lose some of those benefits. You may be wondering right now, what should I be doing? Should I wait for full retirement age or not? This is what I'm going to cover in the video right now. Okay, so as I mentioned, the full retirement age for Social Security is the age of 67 years old. It is significantly more than if you took it at 62. You got certain different periods, right? You got age 62, you got like 65 and 67 that you can take out money, and the longer you wait, the bigger the amount is that you can claim, or the more higher percentage of the benefits. So if you want the full 100% of Social Security that's available to you, that is age 67. Now, that being said, if you're like someone like me, where I'm a Generation Xer, Gen Xers tend to be the most skeptical of Social Security. Why? Because we've been told pretty much our entire working lives that it may or may not be there when we get to that point. And I know even if you're a millennial or Generation Z, you're probably even thinking the same thing. Now, if you're a baby boomer, you're already pretty much there, right? You're probably already in retirement by this point or very close. And as a result, you're wondering, now do I take it? And that's a great place to be, a great question to ask, because really it does scale up. And a lot of people will tell you to delay your retirement. But I've got a lot of people where we've also made the argument, this is even our own clients, saying maybe we should take it now. Because there is the prediction that if they don't change things, we could be losing about 20% of our benefits anyways. So even if we waited till that full age, whenever that age is for you, if it's less than 10 years, maybe you're okay. But if it's more than 10 years out, it's very possible that you might end up having 20% less anyways. So what do we do? Now, there's a bunch of different philosophies about how you make this work in your own life, right? Some people will tell you from the traditional financial planning standpoint, they'll say, if you're trying to retire at age 60, for example, let's have you use your IRAs and 401ks in the meantime, use a bigger amount of percentage of those in the upfront. Even though you're not supposed to pull out more than 3%, they might say, well, pull out a little bit more in the beginning to get you at least to 67, and then you can start taking out less of your retirement income from your portfolio, like your 401ks or IRAs, and instead start taking more from Social Security. And that's one way you could delay it and be able to keep that income going and even have it paying you longer. The only risk is we don't have a crystal ball, right? We don't know the future. We don't know what's going to happen with Social Security. And honestly, you don't even know how many years you're going to live. That's another debate I've had with many of our clients in their 60s. They say, well, I could take it now at 62 and start getting income now because I don't know if I'll be alive tomorrow, let alone at age 67. And often when we do the math, it depends. Often if you're going to live past age 80, wait until age 67, will make you more money. The risk is, though, we just don't know. Even if you're healthy, anything can happen, right? And even if you're unhealthy, anything can happen. My dad just made it to age 80, and he never thought he'd make it to age 70. So that was a shocker in and of itself, just the fact to see that he was actually, in that very place, not, really living longer than he ever expected. So it's actually eating up his money faster as a result. And so there is that debate about, do I just take it now because I may not live that long versus wait until later, especially if the government does cut back on the Social Security benefits that we get. And that's all good. Here's what most of my clients get to. They get to the point that say, we don't really give a crap about Social Security, because what can happen is we can actually create our own income faster. And then the Social Security just becomes a bonus. And that's kind of my recommendation in general is, yeah, Social Security, you could wait till 67. And I've had clients that we've talked to about doing that as well, because we have income coming from other sources and other investments. But in truth, sometimes it's better to take it when you're younger. I've had some clients where we've actually taken it at 62, using that income to build up their cash faster to then invest in alternative investments like real estate investing to then generate more income. So they're actually able to take that income to then generate more income. And they'll even take it before they retire. So even while they're still working, still try to claim some of those Social Security benefits to boost up their income, the amount of money they can save and put away to then generate more income from that. So that is one strategy you can use. At the end of the day, if you're not in your 60s already, you're thinking, what do I need to do right now? Well, one, you don't have to keep paying more into Social Security. It was really just a it really became a Ponzi scheme. It was like a kind of borderline legal. I don't know if it's really considered legal. If it were any other person, they would have been thrown in prison for this kind of Ponzi scheme because they weren't using it for Social Security. They were using it as another fund to tap into. But then when all of a sudden we had more retirees than workers funding it, or not as many workers to fund it as we had retirees, especially with the baby boomers moving to retirement, then all of a sudden they started to panic, right? And they've been panicking for a while, which is why they started making 401ks available in the 80s, because they saw the writing on the wall with the baby boomers. So they started making 401ks available, even though it was never meant for you, and it was never really that big of a benefit for anybody, especially in a lower tax bracket anyways. So that's a whole nother conversation right there. So Social Security has been just used and abused in so many different ways. The best thing that our clients do now, especially if they're in their 50s or younger, and even sometimes in their 60s, is they focus on how do we create passive income right now? How do we take this into our control? Because the government's trying to give us the 401k as the answer, but the problem is even with the match, it just doesn't return that well. Even Fidelity's investments, when I went to look at their average, they underperformed the stock market by over 2% a year. So even if you get the match really, when you factor in the match, even if it's 100%, it doesn't give you 100% return. But when you factor in the match long term, it really just makes up for the bad investments and you just make average market returns. So there's almost no advantage to having that 401k. Now, yes, you are putting the money away, you're saving it for later, but the truth is, once you get to that point, they're going to tell you to pull out 3% or less a year. Well, that's not going to do you any good if you finally built up $1 million to live on $30,000 a year. But what if you had that $1 million that instead generated a 10% return of income, of actual income? It's not about trying to compound your interest, it's compounding your income. What if that income was paying out 10%? You're making now $100,000 a year without touching your $1 million of principal. Now, some people will lie to you, tell you you'll get that in the stock market, but that's just not true. That's why they have the 3% rule, telling you should only pull out no more than 3% a year. Wait, you heard about the 4% rule? Yeah, that's not a real rule. And just so you know, that was just a whole sales scheme based on numbers dating back before 1976. Since then, we've been off the gold standard. People are living longer. 4% is a bad rule of thumb unless you're in your 70s. If you're retiring in your 70s, 4% rule can work. If you're not, you're talking about 3%, it's just not enough. So we get people instead to get their money working harder by generating actual income in the double-digit returns sometimes. So as a result, what happens is that now they're making, say, 10% on that $1 million, they're making $100,000 a year versus pulling out $30,000 a year based on what their advisor recommended. How do I know that? Because that was literally one of our clients, Dan, that's literally what happened with him. He was told to pull out $30,000 a year from his retirement account after he retired from the military. This is on our podcast here on this channel. And then after that, he said, no, I don't want to live on $30,000 a year. I live in California. Give me something better. That's where he did his own research and found this, like you guys did. And as a result, he actually started cash flowing over $100,000 a year, doing better investments, alternative investments backed by real estate, that kind of thing. That's the kind of thing that our people start to look at instead is, how do I generate that income right now rather than trying to wait until I'm 62, 67, or whatever age you're trying to wait till. Instead of worrying about that, how do I actually generate income today? And here's the cool thing, guys. Like sometimes people will have debt, sometimes they won't. Sometimes we get people with paid off houses. We're like, well, listen, if you've got a paid off house, here's what we can do as well in your 60s if you're looking at retirement. Not only can we have Social Security, but we can also do a reverse mortgage on your house. Now, some people have a bad impression of reverse mortgages, but reverse mortgage is actually pretty nice because it does give you either a nice lump sum of cash that you can invest to generate cash flow, or two, they'll pay you the income off of that. Yes, they charge you interest, but guess what? When you die, you don't have to deal with it. Your family has to deal with it. They can either turn back the property back to the bank and they just say, good, the property's yours now, or they assume the mortgage and then they take it over. The great thing is, if you have life insurance, you can use the life insurance to pay off that mortgage anyways, and then you can have that property free and clear, and there's no worry. So you can actually prepare by getting more cash flow by saying, great, I'll get that life insurance combined with doing these other investments and getting other cash flow coming in. So I got Social Security coming in, a reverse mortgage maybe paying me a couple grand a month, and I got these other investments from my real estate paying me as well. I could have a very nice retirement, and I don't even have to wait, at least not for the first part of that retirement. I don't have to wait till I'm 59 and a half years old. I can actually start taking that money earlier, and then I can push off Social Security till later. That's one of the ways that we've seen people do it all the time. So the cool thing is many of our clients forget about the whole Social Security standpoint because they say, I don't even want to have to count on it. If I get it, it's gravy. It's extra money that I don't need. That's a much more powerful position to be in versus the average American right now only has about $300,000 to $400,000 in their 60s in their retirement accounts. If you're living on 3%, that means you're living on maybe $10,000 or so a year. You need Social Security to make up that difference. Our clients don't. They realize, I can take that money and make cash with it today. I actually had a client that just got laid off, and she was so happy, not because she got laid off, but that she finally was able to get access to this 401k locked up with 300 grand sitting in it. It's like, great, now we can take that 300 grand, we can invest that money, making maybe $30,000 a year, and if you end up getting another job, great. If not, this will at least help a little bit. In the meantime, she got a severance too. But that 30 grand a year, now we can take that money and reinvest it. We can grow that money and compound our income versus just worrying about the compounding interest, and get to the point where by the time she gets even eligible for Social Security, it's just a nice option. And hey, she can do a reverse mortgage or not. It's totally up to her. And so that's the beautiful thing that you can do if you start planning right now. If you don't, you're going to be like every other American saying, I need Social Security and I need as much as I can possibly get. And you do not want to be in that place of desperation. All right, so you wonder what to do next? Watch this video next and see what you think. See what you can actually do to create that passive income right now.